All right, we are ready to begin our next group of presentations. We are pleased to bring to you Mr. Jeffrey Myers. Mr. Myers is a shareholder from Borland, Wall & Wenzel in Fort Worth, where he practices estate planning, charitable gift planning, and sophisticated tax planning. Mr. Myers attended college at the University of Texas in Austin and obtained his law degree from California Western School of Law, as well as his LLM in taxation from the University of San Diego. Mr. Myers is a member of both the State Bar of Texas and the State Bar of California, and is a fellow of the American College of Trust and Estate Counsel. He's a former adjunct professor at the University of Texas Arlington in the Department of Continuing Education, and is author of a variety of subjects within estate, gift, and charitable gift planning. Mr. Myers' presentation today is entitled Estate and Income Tax Planning with Mineral Interests. Please join me in welcoming Mr. Jeffrey Myers.
Thank you and good morning. Hopefully my voice will make us through this next 45 minutes. Of course, getting a little sick with the varying weathers, but at least I'm here as opposed to some of our other speakers, so I don't know if that is good or bad. Now, in your materials, there's two outlines. One is a referenced outline, which is has the details of the things that I'm going to talk about. Obviously not going to hit upon everything in there. And it goes through just sort of an introduction on the types of mineral interest and their economic interest. Talks about tax partnerships and some of the taxation elements and non-tax elements of the partnership. And then we also go into a little bit of the income tax issues with respect to mineral interest. And we've got some estate planning ideas. And hopefully over the next 45 minutes, what I'd like to do is just touch briefly on some of the types of mineral interest and some of the basic tax elements at a high level. Talk about the use of partnerships when you're representing families with mineral interest. And then go to a case study, because I always find that the case study really illustrates some of the technical concepts, and hopefully the case study is something that you could take back to the office with one of your clients in the near future. And so the PowerPoint really just sort of is a bullet point PowerPoint, so you can look up at something up behind me instead of staring at me, or if you want to look at your material, or just surf the internet, if whatever you choose. And so this outline really came about several years ago with the discovery of the reserves up in the Marcellus Shale up in Pennsylvania. We received a call from attorneys up there that said, we've got all this oil and gas underneath, and they're going to start extracting it. But their client base really had very little, if any, knowledge with respect to mineral interest in general, or how to deal with them in the estate planning context. And so this outline started there and developed over time. We've used it because of our Barnett Shale, then down in Eagleford, and so it's really been a useful outline. Some of it is kind of basic, this first part, but it certainly helps from a refresher standpoint. And when we're talking about the federal tax rules and mineral interest, in order to reap some of the benefits of the tax code, we talk about an economic interest. And you have to have an economic interest in order to be deemed the owner for purposes of income and deductions. And so in practical terms, the economic interest is really meaning having a direct interest in the mineral property and the income therefrom that's sufficient enough to be deemed the owner. And while the code uses the term economic interest multiple times, it doesn't necessarily provide the best definition. And we do have a definition that's in the regulations that's really copied from a 1933 Supreme Court decision, and essentially says that an economic interest is possessed in every case when the taxpayer has acquired minerals in place and they secure through a legal relationship to derive the income therefrom and an expected return of capital. And so that's the loose definition of what an economic interest in order to avail yourself of the issues within the tax code. And when we're talking about the types of economic interest, we have the lease bonus and the royalty interest, which are typically the ones that we're dealing with in the estate planning context. But also, we have the working interest, the overrides, the carried interest, and the profits interest. And so let's start with the initial interest that's going to be obtained, and that's the lease bonus. And that's really, the lease bonus is the consideration that the landowner receives from the lessee, sort of as an inducement to sign an oil and gas lease. They own the minerals, everything underneath, but they need somebody else to start pulling the stuff up. And so the first thing that is signed is that lease bonus. And you really think of the lease bonus as really the guaranteed money, because that is the inducement to sign the oil and gas contract. And so what it entiles the lessee is the ability to enter into the property and to explore and extract the oil and gas underneath. And typically the lease is going to be from a 1 to 5 year term. And again, that's the guaranteed money. The next is the royalty interest. And the royalty is really that part that is retained when the mineral interest owner leases the rights to extract the resources underneath to somebody else. And so that's really sort of the mailbox money, how we refer to it. You've got the guaranteed money and then the mailbox money, and that's the royalty interest. And typically it's defined in a fraction, kind of like a 1/5 royalty, where I lease with my minerals to a third party, and they have the right to enter into my land and to explore and to develop and to produce the oil and gas underneath. And for that, I retain a royalty and a 1/5 interest just in this example. And so now that the mineral interest owner has taken away the lease bonus and the royalty, what's left is the working interest, or it's also called the operating interest. And that is an economic interest, but that interest is not tied to really the ownership in the property, but it's tied for the term of the lease. So if it's a 5-year lease, that working interest has a lifespan of that 5 years. And the owner of that interest, again, has the right to go on the property and to develop it, and they get to keep, in our example, 4/5 of the revenues from the extraction. Now, within the working interest definition, there are two other definitions. One are delay rentals, and the other are shut-in rentals. Delay rentals, the operator signs the lease and says, I'm going to develop this property. Well, the expectation of the royalty interest owners, they're going to go in there and extract the oil and gas and explore. But if for whatever reason they sign the lease and they decide not to go about, similar to today where we have $50 oil versus $100 oil, an additional payment will be made to keep that lease in force. And that's referred to as the delay rental. Now, typically the leases that are signed up today are what we refer to as paid up leases. A delay rental is not paid. The individual, for the term of the lease, can choose whether to go in and explore or not, but they've tied up the property for the term of the lease. And then the shut-in royalty is after there's been exploration and they've actually started to extract the oil, but for whatever reason, again, economics like they are today, they decide to cap things and not continue to pull things out of the land. And so sometimes an additional payment, the shut-in royalty is paid from the lessee to the landowner. And now some terminology. We talk about the royalty interest as a non-operating interest. The working interest is an operating interest. And so by virtue of owning the operating interest, you are deemed the operator. But not everybody that has a working interest is actually an operator where they're going in and extracting the oil and gas. Sometimes those working interest owners will assign that to a third party to actually go in and be the true operator of the oil well or the gas well. And then it's from there that the working interest gets further carved up with the overrides or the carried interest or the production payments or the net profits. But typically with the overriding royalty interest, the individual has signed up a bunch of leases, and let's say that they've given a 1/8 royalty to the royalty owner, and they have a 7/8 working interest. But they don't want to actually do the operations. Their job was really just a middleman collecting things, and they're going to package these and to sell them off to somebody else. What they may do is they'll retain a 1/8 override, is what it's referred to, and then give the rest to another third party, again, further dividing that interest up. So then in that example, you have one person who's just the royalty owner, but they own everything underneath, because at the end of the term of the lease, they still own 100%. Then the override, who was that initial person that acquired the lease, retains an additional 1/8, but have signed over to somebody else another 6/8 to do the actual work on the property. And sometimes the override is used as a way to compensate additional individuals who are working on the project. Landmen, geologists. This is a way for somebody to assign sort of a piece of the action with respect to the minerals underneath and still do it within the context of that working interest. The carried interest, the production payments, and the net profits interest are also additional ways to carve things up. Now, those aren't based on everything that's underneath and just the total production. Those types of payments are really based on whether there's going to be a profit. Within all these types of interest, the working interest is the one that's going to actually have to put up the money. The royalty owner receives their payments free of costs. Now, things have to come up and other people have to spend money, but they're not going to actually have to put money into the project. They're going to get theirs free of cost. The overriding royalties and the other carried interest are free of costs from the standpoint that the owners of those don't actually have to deep into their pocket and pay money to have the production. It's the working interest owner that is actually spending the money to extract the oil or gas from underneath. And so let's talk a little bit about some of the tax treatment on the different interest. In the article as well as the slides, there's sort of a matrix as far as the tax treatment for the lessee and the lessor. In general, though, the tax treatment for the landowner is going to be ordinary income, whether it's a lease bonus, whether it's the royalty interest, or some of the other payments like the shut-in or the delay. It's going to be ordinary income. For the payee, the lessee, the tax treatment is going to either be a capitalization or it's going to be deductible. And so the one anomaly sort of in the code is with the lease bonus. Because the lease bonus is, in essence, it's sort of advanced royalty payments. And so because it's advanced royalty payments, it's ordinary income for the landowner. But with respect to the lessee, that lease bonus and really all the cost of acquisition, which again would be the lease bonus or the shut-in payments, they get to capitalize those payments. And the anomaly is that typically if somebody's going to be capitalizing something on one end, it seems that the person on the other end of the transaction should be able to get capital gains treatment on that. But the IRS doesn't seem to see it that way. They really just see the lease as a way of allocating the oil and gas interest underneath. They don't see the signing of the lease as actually disposing of an asset which would enable capital gain treatment. So the payment of the lease bonus to the landowner is going to be ordinary income. And again, as I mentioned, the bonus, the delay rental are all capitalized as far as the lessee, and all of the different payments, whether it's the bonuses, the royalties, the override, those are all going to be ordinary income. And now these payments are going to be subject to certain deductions, depletion costs, but in general, it's going to be the ordinary income for the landowner. Now, we talked about the different types of the interest, and again, in the estate planning context, it's really just the lease bonus and the royalty interest. Most generally, in the estate planning context, the working interest owner is going to be more business planning than estate planning. And so we'll touch on some of the partnership attributes for both of them here right now for just a couple of minutes. But when we talk about estate planning, we talk about control. And the partnership or the tax partnership, and the partnership can take two different forms. It could be the state law limited liability company, which is favored in a lot of other states, or the state law limited partnership, which we use here in Texas. But that entity is an excellent way for the landowner to own and control those mineral interests going forward in the estate planning process. And there's really three issues that are overriding when the client is coming into the office, and it's governance and ownership and liability. And the limited partnership or limited liability company, through the company agreement or the partnership agreement, provide the context for that day-to-day management, that control of the mineral interest, the decision whether or not to lease it or not, the decision whether, what type of royalty to retain, the decision whether or not to retain a working interest and to be an operator. That's all done with the day-to-day management, either the manager in the LLC or the general partner of a general partner of a limited partnership. But another excellent attribute of both of these entities is the ability to maintain ownership in the property. And that is, in the estate planning process, we're moving assets, we're moving wealth from one generation to the next. But when we're moving assets, oftentimes that means fractionalization. And with the mineral interest or other closely held family interest, fractionalization isn't really a good thing, because you have two children, that it's divided into two. They each have two children, and then just exponentially, the ownership of the asset gets outside of control of the family core. And so the limited partnership is an excellent way to avoid that fractionalization, because the mineral interests are transferred to the partnership, and then partnership interests are transferred to the family. And so you still have that one entity owning 100% and controlling 100%. You could have multiple partners of the partnership, but they have very little control on what happens to the day-to-day activity, and so that the family asset in and of itself is not fractionalized. Along with ownership is the ability to restrict transfers. When you create the entity, the limited liability company or the limited partnership, you get to decide who can be future owners of that entity. Typically, it's designed within a family group, the permitted transferees, so that you can define that, yes, my child can make transfers to his children, or my daughter can make transfers to her children, but ownership of this entity has to stay within the lineal family group. And if there's a transfer outside of that group, the partnership agreement will have provisions so that it could be pulled back in and so that we don't have any unwanted owners. And then liability. The partnership of the LLC provides liability protection, both inside liability and outside liability. While the royalty owner, typically there's very little liability associated with just being a royalty owner. And so liabilities inside the tax partnership are not very great. But the partnership also provides protection to the individual partners if they get sued or if there's a division upon divorce, that those limited partnership interests cannot be awarded to a third party. They can get charging orders, but they can't be awarded to a third party. So the limited partnership provides an excellent opportunity to preserve the family asset and prevent it from being taken by third parties. Now, some of the key provisions within the limited partnership have to do with some of the economics, the capital contributions and tax distributions, as well as management succession and having some buy-sell restrictions. But it's important when you're setting up the limited partnership to not think about just today, but think about the future. We've got this mineral interest inside the partnership, but is the partnership going to require additional funds in the future? And if so, where are those funds going to come from? And if somebody doesn't contribute like they're supposed to, what's going to be the methodology for either a dilution of that individual or a way to set up a loan or other mechanism in case there are additional expenses? One additional expense is going to be ad valorem taxes that are going to be due annually. And if the mineral interest is in there and hasn't quite yet started to generate income, the partnership is going to need additional resources in the future. And so having a mechanism inside the agreement so that everybody knows what they're going to do. And also because in the estate planning context, the mom and dad are going to be transferring these limited partnership interests to trust or to their kids. And while they're trying to transfer that wealth, they don't want to have an economic burden on the transferee. So you want to make sure you have those provisions. Tax distributions. That's another economic burden that could be unintended when you create the partnership, because the partnership is a flow-through entity, and so all of its tax attributes flow through to the limited partners. Now, the limited partnership, unless the general partner is required, doesn't have to make distributions for taxes. And so the partnership could be generating a lot of royalty income and reinvesting it. And there's flow-through income that's going to be passed through to the limited partners. Without a required tax distribution, those limited partners could be put in a pickle because they're going to have the tax liability. So typically you want to make sure that the partnership agreement requires that the general partner make tax distributions if there's going to be taxable income attributable to the various limited partners. Management succession, again, this is a control piece. When creating the entity, the mom and dad can decide, okay, who's going to be manager today, but who's going to be manager tomorrow and in the future. And then as well as buy-sell restrictions. Typically within the mineral interest partnership, the other family members aren't necessarily going to want to dispose of it. But there could be situations where one of the other family members wants out of the partnership. They want to cash in. And you can prevent them from selling it to a third party, but it's also good to put into the agreement a mechanism if they want to be selling to family members so that everybody knows what the terms are going to be. Now, the distinction between an assignee and a substitute limited partner really has to do with valuation. You can transfer a limited partnership interest, but until they become a substituted limited partner, they're an assignee, which means they just have all the economic rights of a limited partner, but they don't get to do any of the voting that a limited partner would actually get to do. Typically, there's a mechanism in the partnership agreement where that new interest owner is voted in as a substituted limited partner. And there's a distinction in the valuation context when you become an assignee or if you're a substituted limited partner. So we talked briefly about the types of interest, a little bit about the partnership. We'll hit it at a high level, some of the basics when you're talking about mineral interest and some of the taxation with the partnership. And that's in IDC, the intangible drilling cost, basis, depletion, and then recapture. The IDC is huge with respect to working interest operators, because they're expending all of this money to extract the oil and gas from underneath. And the cost that they are expending, they get an option. And that option is whether or not to expense those items, to take a deduction on an annual basis, or to capitalize those items if they ultimately sell the property, that'll increase their basis and minimize the gain. Typically, operators are going to want to expense the items because that's a current deduction. And typically, these interests aren't something that are going to be monetized in the future. So it's a one-time election that's made at the beginning that the cost of, for wages and for fuel, repairs, hauling, supplies, those costs that are incident with drilling and the preparation of the well, those get to be deducted on an annual basis. Other items, like equipment that are going to be depreciable, those get treated elsewhere. But when we're talking about the partnership, we talk about the partnership in the context of the mineral interest, but not so much with the working interest, because of the passive activity loss rules that essentially prevent the ability to expense these items if an individual is just a passive owner. And if you own an interest in a limited partnership or an LLC, you're a passive owner. And so the passive activity loss rules say that you can't expense these items on an annual basis. And so when working with the mineral interest owner and the working interest owner, deciding whether or not to use the limited partnership, you need to make an economic decision of what's more valuable, the liability protection or the ability to expense those items. And typically it's the ability to expense those items. And so what's done in the estate planning context is the working interest owner will get additional insurance, and all of his or her other assets will be held in trust or partnerships so that they are protected. Basis. There's really three main rules under subchapter K when we're talking about partnerships and basis, and that's section 721, 722, and 723. 721 essentially stands for the proposition that the funding of a partnership is not a recognition event. There's no gain or loss recognized when somebody creates a partnership and transfers his or her mineral interest into the partnership in exchange for limited partnership interest. And so that's the general rule. 722 and 723 have to do with the basis of those limited partnership interest, and that's deemed the outside basis, or the basis of the property inside the partnership, which is deemed the inside basis. And essentially, it goes to the fair market value on the date of contribution. On the date I contribute assets, my mineral interest, to a limited partnership, the fair market value of those assets on the date of contribution is going to be going to deem as far as my outside basis, my basis in my limited partnership. And likewise, the basis in the contributed property on the date of contribution establishes the basis of the property inside the partnership for purposes of allocating gain or loss and the depreciation deductions. And so because there's not a taxable event, there's not a shifting of basis when we contribute those assets at that time. And now tax partnerships for mineral interest and just ordinary limited partnerships are two different animals. And typically we leave that with the accountants versus just the legal structure and day-to-day operations. But it is important to understand that the taxation and the accounting, not so much the taxation, but the accounting is different, because with a tax partnership for mineral interest, all those attributes are deemed held by the limited partner versus being deemed held by the partnership, where the books and records are really handled at the partnership level versus at the partner level versus the partnership level. And so the allocation of gains and losses and depreciation are handled differently by each of the limited partners based on their basis versus what is just allocated pro rata. And so that's just a brief comment as far as the actual taxation. Now, the depletion deduction, as Donald Trump would say, this is huge. Back in 1975, when oil gas prices were just skyrocketing, and big oil companies were deemed as gouging the taxpayers, the depletion deduction was a percentage deduction, and it didn't really bear any relativity to the true economics. And so people thought it was just an unnecessary subsidy from the government to big time oil, because the percentage depletion again is just stated percentages regardless of what the price is and what your actual costs were. And so that deduction was just the ability to not pay income tax on revenues. And so because of the perceived gouging, Congress was going to change from the percentage deduction to a true cost depletion deduction, so that you did get a deduction, but it was going to be based on what you actually pay and what you actually pull out of the ground. Well, like a lot of bills, there was a lot of wrangling, and the small-time oil and gas operators were saying, hey, wait a second, we don't handle all the different attributes of the oil and gas production, extraction, and retail sale like the big-time oil companies. And so while they should be penalized and just be allowed to do the cost depletion deduction, the independent operators should still get to be able to have the choice of what's going to benefit them, whether it's the percentage deduction or the cost deduction. And so that compromise is ultimately what went through Congress, where integrated producers, those people that really control the oil and gas production from A to Z, coming out of the ground and pumping it out of the pump, they are limited to the actual cost when they're doing the depletion deduction. The small-time oil producer, they get to choose whatever is the better between the two in order to determine what they're going to be paying. Finally, recapture. What the code gives you, it also takes away. And while the depletion deduction and the intangible drilling costs get to be deducted on an annual basis, if an individual ultimately sells their mineral interest or their working interest, all of those items are going to be recaptured. And essentially, because they got to escape income tax on those items on an annual basis, when they're ultimately selling the property, what they got to deduct is going to be turned into ordinary income, instead of capital gains. Now, what I'd like to do in our remaining time is try to jump over to a case study to try to give you something to take back to the office just on the estate planning context. And here we have Mr. and Mrs. Smith owning 400 acres of land, and they own all the minerals underneath. They have 2 children, a son with 2 children and a daughter with 3. And they've been approached by a big-time oil company regarding leasing the property. And the lease bonus has been discussed at $2,500 an acre or $1 million. and then a 25% bonus. And so Mr. and Mrs. Smith decide to come to you to see what they can do from an income tax standpoint or an estate tax standpoint. And so one of the things that you talk to them about is if they want control of the property, obviously we're going to set up the limited partnership. And again, with the limited partnership, there's the creditor protection from marital discord, as well as if there's a third-party creditor claim. And in our example, see my slide here, a little different in my notes. In our example, Mr. and Mrs. Smith are going to own 100% of the partnership. 99% of the equity is going to be represented in the limited partnership interest, and 1% of the equity is going to be represented in the general partnership interest. There we go, that slide. And so once they create the partnership, they then, through the general partner, will lease the property to the big-time oil company and receive the $1 million of lease bonus inside the partnership. So now they have the partnership. It owns the minerals. It has a 25% royalty interest, and it has that $1 million from the lease bonus. At that point in time, they can decide whether or not to transfer the assets to the kids now or transfer it later. The benefit of transferring it now is there's very little value other than that lease bonus because there's been no production. Once there's production, the value of the partnership can increase in value. In this instance, they decide, since they're not generating any income right now, it doesn't affect their lifestyle, they're going to go ahead and make a transfer over to their kids. And what we talked to Mr. and Mrs. Smith about is doing the Grantor Trust. I know that most of you have heard about the Grantor Trust. That's a trust where Mr. or Mrs. Smith create it, and for income tax purposes, they're treated as the owner. But for estate, GST, gift tax purposes, they don't own the assets inside. And the benefit of the Grantor Trust is that they pay the income tax, and so by doing that, that's sort of a transfer tax-free benefit that the trust receives. Also, they're allowed to sell assets to that trust in an income tax-free manner. They can be trustee of the trust. They can let the kids be trustee of the trust. And in this instance, Mr. Smith creates a trust for daughter. Mrs. Smith creates a trust for son. The next step that happens is evaluation. And when we're talking about mineral interest and limited partnership interest, it's a two-step evaluation process. The first thing we have to value are the assets of the partnership. And again, in this instance, it's the $1 million cash as well as the 25% royalty interest. And then once we determine what that value is, then we need to value the limited partnership interest. Because again, that's what Mr. and Mrs. Smith are going to be transferring. Remember, they're not fractionalizing the ownership in the mineral interest underneath. They're going to give the kids ownership in the limited partnership. And through the valuation, it's determined that a 25% interest in the partnership is valued at $418,000. You can see that, $418,000. And in this instance, they've decided that they're going to share a little bit with the kids, but they're going to retain some from themselves. And so they're going to put at play 50% of the value of the partnership and retain 50% of the value of the partnership. And so the first thing that they're going to do is they're going to make a gift, a 3% limited partnership interest gift to the trust. And based on that valuation, that gift value is $50,000. Now, that's going to use a little bit of their lifetime credit, but as we know, the lifetime credit has gone up to over $5 million per person, so it uses a very little amount of that lifetime exemption. Now, the next thing they're going to do is they're going to sell a 22% limited partnership interest to the trust, and they're going to sell that for $368,000. And so they've done a combination of a small gift and a sale. and they're going to take back a promissory note. So they're going to get some of their capital back from this transaction. But let's look at just sort of some economics if this pans out. If the oil and gas starts to produce, and over this 7-year time period, you'll see the varying royalty interest. But at the end of the 9-year term of the promissory note, the kids' trust are going to pay back mom and dad the principal payment, the $368,000. They're going to pay the interest due on the note, which was about $48,000. So mom and dad are going to get back $416,000. But in the trust, net of transfer tax costs, net of the income that mom and dad pay, the kids are each going to have about $870,000. Mom and dad, they only gave away 50%. And while they were paying all the income tax attributable to those mineral interests, they're still going to net almost $675,000. Now, with the increased exemption, Mr. and Mrs. Smith could have just made a gift of the whole 25% to each of the trust, not paid any gift tax, and still moved some of the wealth. But through this transaction, they've retained most of their unified credit and exemption equivalent amount. So we have the ability to minimize or eliminate estate tax in their estates. But now the kids are beneficiaries of this trust that will generate, hopefully, income for the future. Well, I appreciate your time. I'm out of time now. Hopefully that gives you a little understanding of some of the interests that are derived from having mineral interest in the ground, the effect of the partnership, some high-level tax issues, and hopefully an estate planning technique that you can take back to the office. While this outline was done years ago as far as the Marcellus Shale, this actual plan is one that we've just implemented because it really works well with these type of assets. So I appreciate your time this morning. Have a good afternoon.